gold has become a competitor for those seeking really an alternative to high counterparty risk treasuries. The Fed will have to adapt, or the dollar and bonds will reach a globally driven inflection point where, relative to gold, treasuries and the dollar debasement risk will accelerate. Well, every well-connected liquidity provider and first-tier bank we speak to assess full Basel III COMEX market compliance will be forced by the end of the 2023 trading. Now, given the paper-to-physical structural unwind, and at best estimate, we've done a lot of research and chatted to liquidity providers about this. To revalue that at 2,000, then probably you get a $500 buffer above 2,000 as the price, the paper to physical battle gets resolved. So somewhere 2,500 perhaps, or thereabouts. Then what happens? A physical gold price is going to emerge. So from this point onwards, all global fiat currencies to some degree would be partly gold backed, and the central banks with the highest gold backing as a percentage of currencies issued would relatively be the strongest currency. A higher gold price is versus the dollar, and it would turn all fiat currencies it's going to, it would suit central banks to have a higher price. Speaking of the Fed, let's just see why the Fed is the only central bank that has got gold so wrong. No one's really drilled into this. Multiple high respected Fed insiders, some of them who I've interviewed here in Live from the Vault episodes over the years, all concur that the Fed does not understand gold. Agreed. In fact, every report we hear, bar none, indicates that the Fed never discusses gold, that it's simply not on their radar. However, recent footprints tell us this is no longer strictly true. And this recent US dollar downgrade that we just experienced just underscores it, really cements it. First tier liquidity provider aside, it indicates that following Basel III and SFR conditions turning gold back into a first tier asset class on the 1st of January, and for all the wrong reasons, gold did appear on the Fed's radar for the first time since Nixon ended Bretton Woods' system of fixed exchange rates for gold. Now, it cannot be ignored that for the first time since Bretton Woods was slammed shut over 50 years ago, that following gold becoming a first-tier asset class, gold once again reared its head to compete against all-hallowed treasuries. And as we highlighted last episode, during 2022, bonds suffered their worst ever performance since Nixon pulled the dollar's exchangeability into gold, while simultaneously it's not going unnoticed that central banks, sovereigns and institutionals seeking an alternative safe store of value are diversifying out of US treasuries into competing zero counterparty risk, competing first tier asset class physical gold. So gold as a competing first tier asset class now undoubtedly has the Fed's attention. So what they're doing is the specs inside the casino are holding these paper gold hedges, and this is the split group, into situations such as we're just witnessing. When the market woke up, in particular what we see was when the market woke up to Fitch blindsiding the Fed and Treasury Secretary Yellen, downgrading the US from AAA to AA+, and then it spooked the risk markets. So, gold really doing what it should do on the box. However, following the surprise Fitch US downgrade, which should have been very bullish for gold versus the dollar and treasuries, obviously, coordinated official interventions immediately pushed back against the downgrade, evidencing officials aggressively intervening in the foreign exchange dollar crosses, all of them, which of course includes gold and silver. Officials actually admit to intervening in the foreign exchange markets, but in a situation like this, which of course includes gold and silver, in a situation like this, really counterintuitive action to what should have been happening. And while we expected to see some continued short-term official pushbacks against this US downgrade, if that wasn't enough, Moody's followed through downgrading 10 US small and mid-sized banks with an indication that the larger banks, yes, the big guys, that downgrades will follow for the big guys. Now, this drew in some fresh Fed-driven interventions jumping to prop the dollar up. However, these downgrades what they've largely resulted from is because of the pace of higher rates, which under the official line of rates higher for longer, which we see the Fed officials talking about, or many, it means that officials are walking a rate tightening, really, tightrope, with particular concern over the small banks holding actually over 80% of the underwater high-risk commercial real estate sector loans. Now, this we talked about this before. This is the next bank shoe to drop, and it undoubtedly has the Fed's attention, especially as there is the pace of interest rate rises that caused the problem in the first place. So to understand exactly what we're currently evidencing into what is undoubtedly official interventions, which explains exactly the counterintuitive action we're seeing, the US Fitch downgrade from AAA to AA+, it roiled the dollar crosses immediately, spiking rates higher, and with over $1 trillion in US debt that has to be sold in the third quarter to finance US government borrowings, we've evidenced a coordinated official intervention to prop up the dollar against the foreign exchange crosses, which again include foreign exchange gold. Now, as an asset class, first-year gold increasingly competes against US Treasuries, hence the verbal pushback from Yellen and the White House, of course, coordinated with a hard currency official pushback and intervention, particularly focused on, and what they were focusing on was the net stable funding ratio compliant foreign exchange gold cross, which crosses with the COMEX. But of course, what they did was what the Fed generated was paper gold inside the leveraged, non-compliant, cash-settled COMEX exchange.